Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. So we are from group 8. We're going to present about business finance, specifically about needs and sources, cash flow forecasting, and working capital. These topics will be presented by myself, Syofianda Latifah, and also my partner Diva Puspa Ningrum. So the first topic will be presented by Diva. The floor is yours.
All right, thank you. So now I'm going to explain about the first topic. It's about the business finance needs and sources. So for this material, there are several key points. The first one is why business need finance. Second one is sources of finance. The third one is about short and long-term finance. And the last point is about sources of finance and about the details is about how business makes the choice. Now we jump to the first one. It's about why business need finance. So what is finance? Finance is money. We all need money to purchase the goods and service we require every day, like food, but also more expensive items such as house or car. And in business, we also need finance. This is often called as capital. Without finance, they couldn't pay wages, buy materials, or pay for assets. And here are the several reasons why capital is needed. The first one is the starting up a business. Important things that we should know in business is the term called as fixed assets. It's when individuals starting a business and they have to consider about the buildings, land, and the equipment to start a business. And the next is about the expanding an existing business. Business owners usually expand their business to gain more profits, which requires substantial amounts of finance or for R&D. And there are several ways in expanding a business, such as additional fixed assets and developing products to reach new markets. And the last reason is about increasing work capital. Working capital means it is a finance that is constantly needed by firms to pay for all their day-to-day activities. And in business, the owners may need finance to pay for their capital expenditure or revenue expenditure, and it is important to understand the difference. Now we move to the sources of finance. There are two types of sources. The first one is internal finance and the second one is external finance. The internal finance have several examples. The first one is retained profit, or we also can call it as pullback profit. It is the profit in the business after the owner have taken their share of the profits. And here are the following advantages. The first one is retained profit doesn't have to be repaid, unlike for example, a loan. And also, there is no interest to pay the capital is raised from within the business. And there are several disadvantages of this finance. The first one is a new business will not have many retained profits, and many small firms' profits might to be low to finance the expansion needed. And the keeping more profits in the business reduce payments to owner, for example, dividends to shareholders. Next example is sale of existing assets. As existing assets that could be sold are those items of value which are no longer required by the business, for example, redundant buildings or surplus equipment. This makes better use of the capital tied up in the business, and it doesn't increase the depth of the business. However, It may take some time to sell these assets and the amount raised is never certain until the asset is sold. Resources also not available for new business as they have no surplus assets to sell. Next example is sale of inventories to reduce inventory levels. This reduces the opportunity cost and storage costs of high inventory levels. However, it must be done carefully to avoid disappointing customers if not enough goods are kept as inventory. Next is owner savings. The owners are not separated from their business and therefore such finance is called internal. The advantages is it should be available to the firm quickly and there's no interest is paid. While the disadvantages our savings may be too low and it increases the risk taken by the owner. Now we move to the external finance. The most common forms of external finance are the first one, issue of shares. This source of finance is only possible for limited company, and there is a permanent source of capital which would not have to be repaid to shareholders, and there is no interest has to be paid. However, the dividends are paid after tax, whereas interest on loans is paid before tax is included. And dividends will be expected to be to sorry dividends will be expected by the shareholders and the ownership of the company could change hands if the next example is bank loan. A bank loan is when a bank offers to lend money to consumer for a certain time period, and these are usually quick to arrange, and they can be for varying length of time. And large companies are often offer low rates interest by banks if they borrow large sums. However, a bank loan will have to be repaid eventually, and interest must be paid. And the security of or collateral is usually required. This means the bank may insist that it has the right to sell some of the firm's property if it fails to pay interest or doesn't repay the loan. Next example is factoring debt. It's the advantages of factoring debt is immediate cash is made available to the business, and the risk of collecting the debt becomes the factors and not the business. However, the firm doesn't receive 100% of the value of its debt. The other example is grants and subsidies from outside agencies. The subsidies and grant usually do not have to be repaid, but however, uh, they are often given the string attached. For example, the firm must located in a particular area. And the last example is microfinance. In many low-income developing countries, traditional commercial banks have been very unwilling to lend to poor people, even if they wanted to the finance to set up the enterprise. And bank didn't lend because the first, the size of the loan requires by poor customer, perhaps few dollar, mean that the bank couldn't make a proof from the loan. And the poor groups in society often have no assets to act as security for loans bank and are usually not prepared to take risks by lending without some form of security. Next, we jump to the short, short and long term. Sorry, it short and long term finance. First one is short term. Short term finance refers to this provides working capital needs by business for day to day operation. Shortage of cash and in the short term can be overcome in three main ways. The first one is overdraft, and these are arranged by a bank. This give the bank give the business to the right to overdraw a bank account, that is spend more money than is currently in the account, and the firm could use this finance to pay wages or suppliers, but obviously it cannot do this definitely, and the overdraft will vary each month with the needs of the business, and it is said to be a flexible form of borrowing. The interest will be paid only in the amount overdrawn, and the overdraws can turn out to be cheaper than loans in the short term. However, the interest rates are variable, unlike most loans which have fixed interest rates, and the bank can ask for the overdraft to be repaid at very short notice. The second way is trade credit. This is when a business delay paying its suppliers, which leaves the business in a better cash position. It's almost an interest-free loan to the business for the length of the time that payment is delayed for. However, the supplier may refuse to give discounts or even refuse to supply any more goods if payment is not made quickly. And the last ways is factoring debt. So the advantages of this ways are immediately cash is made available to the business, and the risk of collecting the debt becomes the factors and not the business. However, the firm doesn't receive 100% of the value of its debts. Next, the long-term finance. This money usually used to purchase long-term fixed assets, to update or expand the business, or to finance a takeover of another firm. The main sources of long-term finance are as follow. The first one, bank loan, and there's the advantages are these are usually quick to arrange, and they can be for varying length of time, and the large company are often over low rates interest by banks if they borrow large sums. However, a bank loan will have to be repaid eventually and interest must be paid. And the security or collateral is usually required. This means the bank may insist that it has the right to sell some of the firm's property if it falls to pay interest or doesn't repay the loan. And a sole trader may have to put his or her own house up as security on a bank loan. Next, there is hire purchase. It's buying fixed assets over long periods of time with monthly payments which include interest charge. The firm doesn't have to find a large cash sum to purchase the asset. However, a cash deposit is paid at the start of the period, and the interest payments can be quite high. Next is the leasing. The advantages of leasing are the firms doesn't have to find a large cash sum to purchase the assets to start with, and the acquisition and maintenance of the assets are carried out by the leasing company. However, the total cost of the leasing charge will be higher than the purchasing the assets. And Other sources are issues of shares. This source of finance is only possible for limited companies, and there is a permanent source of capital which would not have to be repaid to shareholders, and there is no interest has to be paid. However, dividends are paid after tax, whereas interest and on loans is paid before tax is deducted, and dividends will be expected by the shareholders. Also, the ownership of the company could change hands if many shares are sold. Next, the long-term loans or the debt finance. Loan differ from share capital in the following ways, such as loan interest is paid before tax and is an expense. Also, it must be paid every year, but dividends but do not have to to be paid if, for example, the firm has made a loss. And loans must be repaid as they are not permanent capital, and the loan are often secured against particular assets. Next, debentures. These are long-term loan certificates issued by limited companies, and debentures can be used to raise very long-term finance, for example, 25 years. However, as with loan, there must be repaid to interest must be paid. Next is about the source of finance is the last one, and how business makes the choice. The purpose and the time periods. The general rule is to match the source of finance to the use that will be made of it. And if the use is long term, for example, the purchase of the fixed assets, the source should be long term. And if the use is short term, for example, the purchase of additional inventories to cover a busy period, the source should be short term. And there is a amount needed, as different sources will be used depending on the amount of money needed. And also there is legal form and size. The, uh, the company, especially public limited companies, have greater choice of source of finance. Meanwhile, the sole traders and partnership, they have limited choice comparing to companies. If the sole traders want to do expand, they only depend on the savings of their owners' personal capital. And the risk and gearing does the business already have loans? An important point about loan capital that I will raise the gearing of business, and this is a common measuring of risk that the managers are taking. The gearing of business measures the proportion of total capital raised from long-term loans. If this proportion is very high, say more than 50%, the business is said to be highly geared, and this is said to be a risky way of financing a business. And this is risky because interest must be paid on the loans whether the business is making profits or not. When interest rates are high and the company profits are low, the firm might maybe not able to pay all of the interest. The future of the business will be at risk. Therefore, banks are usually reluctant to lend to highly geared business, which may have to use other source if in finance. Next, for the next topic will be presented by Syofianda. The floor is yours.
Okay, thank you, Diva. So next topic, which is cash flow and forecasting, and also working capital. And I will present this material. So let's move on to the next slide. Okay, in this topic, I will explain to you five key points. First is why cash is important in business. Why, and second, what is meant by cash flows, and also the cash flow forecast itself, and how can cash flow problems be overcome, and the importance of working capital. Let's move on to the first slide. Okay, the first slide is the first topic is why cash is important. Here are several major problems will be faced and happen if your business has too little cash or even run out of cash when you are constructing a business. These are a major problem that you will be faced. The first is unable to pay workers, suppliers, landlord, and government, which is will affect to the stability of your business, especially for the paying of workers. And second, you also will face the production of goods and service will stop, workers will not work for nothing, and suppliers will not supply if they are not paid. The business may be forced into liquidation, a liquidation selling up, ev- everything it owns to pay its debts. So that's why the stability of your business, if you run out of cash, will be worse. Second, the second topic is what is meant by cash flow. Okay, there are five the most common ways of cash inflows. Let's talk about the cash flow itself. Cash flow of the business is the cash inflows and outflows over a period of time. Cash flow, cash flow and outflows. First, cash flow inflows are the sums of money received by a business during a period of time. Meanwhile, cash outflows are the sum of money paid out by a business during a period of time. So that's the difference between inflows and outflows. Next. Okay. These are the five the most common ways of cash inflow. The first is the cash will become from the sale of product for cash. And also, payments might made by debtors are customers who have already purchased products from the business but did not pay for them at the time. And the third, cash inflow also comes from borrowing money from an external source. This will lead to cash flowing into the business. And then the sale of assets of the business, for example, unwanted property, and also from investors, for example, shareholders in the case of companies putting more money into the business. Next, five most common ways for cash outflows. Usually it happens because purchasing goods or materials for cash, and also paying wages, salaries, and other expenses in the form of cash. And third, purchasing fixed assets. Fourth is repaying loans. And five, by paying creditors of the business, other firms who supplied items to the business who were not paid immediately. Now, let's talk about the cash flow itself. Here is the scheme of the cash. Here is the scheme of the cash flow cycle, which consists of several steps. So let's talk about this scheme. Okay, as we can see from the cash flow, we can see the importance of planning for cash flow itself. What would happen? First, a business did not have enough money cash at stage one. Not enough materials and other requirements could be purchased, and so output and sales would be full. Also, a business insisted on its customer paying cash at stage 4 because the business was short of money. It might lose the customer to a competitor who could be offered credit. And a business has insufficient cash to pay its bills, such as rent and electricity. It would be in a liquidity crisis, and it might be forced out of business by its creditors. Next, what is meant by cash flow? Cash flow is not the same as profit because profit is the surplus after total costs have been subtracted from sales revenue. There's a clear difference between profit and cash actually. Usually cash figure lower than gross profit because although all goods have been sold, cash payment has been received only half of them. The customer buying the goods on credit will pay cash in the latter month. So that's why the cash flow will be subtracted. Here is the possibility of a business run out of the cash. And first is, can profitable business run out of the cash? Yes, of course. And this is a major reason for business failing. It is called insolvency. How this could be possible happen? First is allowing customer too long a credit period, perhaps to encourage sales, and also purchasing too many fixed assets at one time, and also expanding too quickly and keeping a high inventory level. This means that cash is used to pay for higher inventory levels. This is often called overtrading. Next, now let's talk about the cash flow forecast. What is cash flow forecast? It is an estimate of future cash inflows and outflows of a business. This usually expected by the manager. Okay, next, the manager of a business have to know how cash will be available month by month, which is called cash flow forecast. And also cash flow forecast will show the manager several things. The first is how much cash is available for paying bills, repaying loans, or for buying fixed assets. And also from the cash flow forecast, the manager also show how much cash the bank might need to lend to the business in order to avoid insolvency. And the third is whether the business is holding too much cash, which could be put to a more profitable use. Now, what is the uses of cash flow forecast itself? The first is starting up a business, and also it could be a running an existing business or keeping the bank manager informed, and also can managing the cash flow itself from the manager. Okay, let's move on to how can cash flow problem be overcome. There are several ways in which a short-term cash flow problem could be overcome a long-term cash flow difficulties. How we face that? The first is attracting new investors. For example, by selling more company shares, but it will affect ownership of the business. And second, cutting costs and increasing efficiency. But this will be but will this be popular with employees, and could product quality be affected? And the third is developing new products and that will attract more customers. This could take a long time and needs cash in the short term for pay the research and development itself. In on this slide, we also provide the limitation of the table of how the cash flow to be overcome, as you can see on our slide. Next. Not, Now let's move on to importance of working capital. The term of working capital refers to the amount of capital which is readily available to a business. Working capital is also the capital available to a business in the short term to pay for a day-to-day expense. Working capital actually is also the lifeblood of a business. No business can run effectively without a sufficient quantity of working capital. Let's talk about how working capital may be held in different forms. The first is cash is needed to pay day-to-day costs and buy inventories. And also, the second, the value of a firm's debtors is related to the volume of production and sales. To achieve higher sales, there may be a need to offer additional credit facilities. And also, the value of inventories is also a significant part of working capital. Not having enough inventories may cause production to stop. On the other hand, a very high inventory level may result in a high opportunity cost. Okay. Okay, that's all about our presentation regarding the topic of business finance, cash flow forecast, and uh, cash cash flow forecasting, and also working capital. So thank you for your attention. See you on the next presentation. Assalamualaikum warahmatullahi wabarakatuh.